What's up, everybody? Nate here, and the Federal Reserve is gearing up for its next FOMC meeting on November 1st. Now, at this meeting, the Federal Reserve is going to be talking and discussing major monetary policy decisions that are going to have a pretty massive impact on our economy as a whole, especially on inflation, and they plan on releasing all of the details to the public on November 2nd. So, in case you haven't been following along, the Federal Reserve has been aggressively raising its interest rates pretty much all throughout 2022, and the big question right now is what exactly are they going to do next? Some Federal Reserve governors believe that interest rates need to be a whole lot higher, and others believe that the Fed needs to start tapering right now and actually lowering interest rates once again. So with all of this being said, no matter what they do, it's going to have an impact on our economy. So today I kind of want to paint the picture of what the Federal Reserve is dealing with right now, what they're looking at, who all of this is going to affect, and what we can expect next for the Federal Reserve and our economy in 2023. All right, so let me kind of set the scene for what the Federal Reserve is looking at right now. So the Fed is actually paying attention to two major things. They're looking at inflation and they're also looking at jobs numbers. Those two factors are going to influence what the Federal Reserve does with its monetary policy, i.e. interest rates on its next meeting and throughout the rest of 2022 and in 2023. So let's go ahead and take a look at the inflation side first. So inflation in the United States as of its last reading for September 2022 showed that consumer prices all throughout the country actually accelerated faster than most people were expecting by around 8.2% on a year-over-year basis. What this means is that everything is going up in price. So the cost of living is going up and grocery prices are going up and just about everything from energy to shelter. All of these things are starting to rise, and that is a big problem for our economy and also the Federal Reserve. Now, the Federal Reserve itself actually looks at another number. They actually look at something called core inflation because to them, this gives them a little bit of a better reading about how inflation is progressing in our economy. Core inflation actually excludes the volatile industries like food and energy, and it gives a little bit of a closer benchmark for the Federal Reserve when they set their monetary policy. Well, what exactly does inflation mean? Well, inflation has a couple different definitions, but what we're really most concerned with is sort of the symptoms that inflation kind of brings on. So over the last couple of years, the Fed has printed a lot of money and it's done a lot of quantitative easing on Wall Street, and that has meant there's been so much money in circulation. There has been a lot of overspending in our economy, which means all of your prices, the symptom that I'm talking about, are starting to go up. So prices in the United States are starting to rise, and that's a big problem because now everybody has to pay more for all of their goods and services. But as you start to pay more for things, well, Americans just aren't really going to be happy with this type of lifestyle because eventually you're just not going to have enough money. Your buying power for the money that you do have is only going to be going down because you have to pay a lot more for all of the same things that you were buying before. So that's not a good situation. And the problem is people now have to make a whole lot more money from their jobs in order to buy all of the same things. That is completely unsustainable from an economic side because it means that the value of every dollar in circulation is really going down in terms of value every single day. So now every single dollar that is out there, people just need a whole lot more, and eventually this can get way out of control. So that's the inflation side. And if we take a look at the job side, well, unemployment in the United States currently sits at around 3.5%. That is the lowest that we have seen in a very long time. And typically when you have really low unemployment, the Federal Reserve likes to raise interest rates, and you typically have really high inflation as well. And the reason for this is because everybody in your economy has a ton of money, and it shows to the Fed that, well, we've had a lot of economic expansion. With the jobs market so strong in the United States, it's the Federal Reserve's job to kind of soften the jobs market in 2022 or next year because they want to have fewer people employed, so that way fewer people can go out and spend as much money, and that will bring down inflation in general because now people are not going to have as much money. So those are the two things that the Federal Reserve is looking at. They're looking at inflation and they're looking at the jobs market, and the goal for the Fed right now is to sort of bring down both of those. They actually want to increase unemployment, and they also want to lower inflation by reducing demand. Now, how exactly do they do that? Well, the number one tool from the Federal Reserve is their interest rate policy. So the Federal Reserve can induce a ton of demand in our economy by lowering their interest rates, or they can suck out that demand by raising their interest rates. Now, over the last couple of years, they wanted a ton of demand. There was a lot of money printing, and that meant that inflation went way up. But it also meant that our economic expansion also started to boom. That's part of the reason why we have really low unemployment, and it's part of the reason why inflation is so high right now. So the Federal Reserve now has to do the inverse and start to raise their interest rates. That way there's not as much demand. So think about exactly what that means. When the Federal Reserve raises its interest rates, that means it's a whole lot harder for people to get a mortgage. It's a whole lot harder for people to get a car. It's a whole lot harder for businesses to expand because all of those things are grown with debt. If debt is really expensive to take on, then people are naturally not going to be able to go out and get a mortgage because their mortgage payments are way too high. Same with an auto loan, same for spending on a credit card. And it also means that businesses are not going to get as much money to grow, and all of the debt that businesses have is also going to be a lot more expensive to pay off. And like I mentioned at the beginning of this video, the Federal Reserve has been raising its interest rates pretty aggressively and quickly throughout 2022, and that means that we've seen things like the mortgage market and the stock market and all of these other markets start to fall in the United States because people just don't have the same access to those things like they did in 2021. So now that affects everything in our economy, and this is what you've got to keep in mind. It's like a domino effect. The Federal Reserve raises its interest rates, makes it so that fewer people enter the housing market, and with fewer demand in the housing market, then eventually you're going to start seeing prices come down in that market because nobody is able to afford a home because interest rates are so high. That means prices have to come down so that way more people start to enter the market. Now that is true for just about every single market, especially the stock market. We have seen the stock market fall in 2022 and essentially erase most, if not all, of its gains that it's gotten over the last couple of years because there's just not as much investor interest because it's a little bit more risky to enter the stock market. As those interest rates go up, well, now your businesses are not able to expand as quickly, which means they can't bring in as many profits, and that hurts investors because if these businesses don't have as many profits, then the stock prices are going to come down. And what it also means is that inflation in just about every industry is also going to shrink because there just isn't as much spending going on. What it also means is that unemployment could rise because a lot of these businesses have to take on investor liquidity and a lot of debt in order to grow their company. So without that money, they now can't pay their current employees and they can't hire new ones. So job postings are going to go down. We've started to see this so far in 2022, and we could start to see more and more layoffs and unemployment rise throughout the US. Now the big question is, what exactly is the Federal Reserve going to do with its interest rate policies next? So we know that inflation is really high, and we know that the jobs market is also really strong in the United States. So the Federal Reserve is going to have to do as much as it can to bring those things down because, well, raising its interest rates is really all it can do to fight inflation and also soften the jobs market. But to be completely honest with you, I have no idea where exactly the Federal Reserve is going next with its interest rate policies. Some are saying that they could raise their interest rates by 0.5%. Others are saying 0.75%. That would be some pretty big hikes, but nobody really knows for sure, and it's really going to depend on what exactly the data looks like for the Fed right now. The bottom line here is this: the Federal Reserve right now is in a fight against inflation. They want to bring down inflation to their target level of around 2%. That is their ultimate goal, and inflation right now is around 8.2%. That is way too high, and it means that the cost of living for everybody is going up. Prices for everything are also starting to rise, and that's kind of creating a catalyst effect for businesses having to pay people more and people spending more of their income on just basic necessities, and that is not a good thing for the Federal Reserve or our economy. So the Fed has to bring down inflation, and they're going to raise their interest rates as much as it takes to bring down inflation in our economy. We don't exactly know what that number could look like just yet. In the meantime, the Federal Reserve has talked a lot about this. It's going to cause some pain, and that is what we can expect into 2023 and beyond. Some pain for our economy, because what you've got to understand is the Federal Reserve can do one of two things, but they cannot do both at the same time. If the Federal Reserve is in a fight against inflation, trying to bring down inflation, then that involves raising its benchmark interest rates, which means our entire economy is going to get restricted. It's going to shrink. There's going to be businesses that shrink. There's going to be consumers that are not able to buy as much as they could over the last couple of years. But on the flip side, the Federal Reserve could lower its benchmark interest rates, right? So that would lead to a lot of economic expansion, and it would lead to a lot more jobs starting to grow, businesses growing, and consumer spending. And that might sound like a good thing at first until you realize what that ultimately includes is money printing and a lot more debt being taken on for businesses and consumers throughout the United States, meaning prices continue to just go up and up and up, and inflation just becomes a much bigger problem. So with that in mind, the Federal Reserve isn't really thinking about the economy at this point. They're thinking about bringing inflation down, and that means the higher those interest rates go, the more jobs we're going to lose, the less economic expansion we're going to have, and the worse off our economy is simply going to be. Once inflation does come down to around 2%, the Federal Reserve can then start to stimulate the economy without really having to worry too much about inflation at that point, but it's going to take them a very long time to get there. This is not an overnight process, just like creating all of this inflation wasn't overnight either. I mean, you got to think the Federal Reserve, the US federal government was printing money in 2020. They were printing money in 2021. We started 2020 with around $3 trillion in circulation, and now we have well over 20 trillion. It took us about 2 years to get to that point, and by the mid parts of 2021, that's when inflation really started to ramp up. Now it's obviously extremely high, so it could take a while for all of that demand and all of this money circulating around to finally get sucked out of the system. But this is now where you want to kind of take a look at everything that's happening in our economy and realize that everything is connected. As the Federal Reserve raises its interest rates, that's going to affect a ton of other things. It's not just businesses, it's not just people going out looking for mortgages. It affects just about everything, and financially it means that everything is about to be a whole lot lower in our economy. But like I said before, the Federal Reserve raising its interest rates by 0.5 basis points or by 75 basis points is completely irrelevant. What you have to understand is that you need to be prepared with your finances now, because no matter what happens next, it's going to be major, and you want to be prepared whether it's something that's really good or something that is really bad. Because I can't tell you what's coming next, but being prepared is always better than being not prepared. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.